Hey everyone, after many years of analyzing business performance and the shareholding pattern, I've come to a conclusion that fundamentally strong companies with bright future prospects show a trend where promoters, DIs, FIs would increase their stake in the company and public holding would reduce. And if the fundamentals deteriorate for the company, FIs and DIs would reduce their holding and public would increase their stake. While there can be a few exceptions, this thesis works well in majority of cases. And that's why after every quarter, I do this exercise of identifying companies where smart money is flowing. That is, promoters or institutional investors are increasing allocation and public holding is reducing. Because that gives an idea on which companies are looking fundamentally strong and available at decent valuation. Please note that I also look at the pedigree of FIs and DIs that are adding stake in the company. And I've shared a list of top FIs, DIs I track closely. The best part is, today there's an excellent correction in these stocks in the range of 30 to 50%. Now today when the stock market is in decline trend, it may happen that some of these stocks may continue to fall. Especially the kind of selling happening in mid and small cap stocks in the last few weeks, it has created extreme fear and market sentiments are clearly bearish. But what is more important is long-term outlook. Because if the company is fundamentally strong, corrections creates opportunity. So in this video, I have identified 9 stocks where institutional investors are consistently increasing allocation and public holding is consistently falling. This exercise has really helped me identify some great names and build my conviction. But before we discuss these stocks, please note that there is no guarantee that if FIs and DIs have added this stock in the past on consistent basis, they would continue to do so. And you don't need to directly jump and buy all the stocks. In my opinion, there's enough time in 2025 to research and understand business fundamentals, future growth drivers, key risks and so on. And slowly build conviction before deploying your money. Because ultimately the most important part of long-term investing is conviction. And that comes only when you invest with knowledge. So utilize this correction in 2025 to study great business and narrow down a few good long-term stocks to be added in systematic manner. Alright, let's get started. First stock in the list is Mrs. Bector Food. Company manufactures biscuit under the brand name Cremica and bakery product under the brand English Oven. Apart from its B2C model, company also operates in B2B model where it supplies bakery product to top QSR chains of India like Medi, Domino's, Subway and so on. Public holding in the company has consistently reduced from 33.8% in June 22 to 15.6%. FIs have massively increased their stake from 1.3% to 15.6%. And DIs also increased their stake from 13% to 19%. Although there is slight reduction in DIs holding recently as FIs have added stake aggressively in the company. Mrs. Bector share has also corrected around 40% from the peak. Although the bakery and biscuit segment is very competitive, Mrs. Bector has been growing at a good rate and management expects the company to grow at 2 times the industry growth rate. Company has taken multiple initiatives including capacity expansion for both bakery and biscuits, expanding its geographical presence, new product launches including healthy snack segment and ground level marketing to improve brand visibility. Okay, before we continue with the next stock, I want to share something valuable with you all. If you can dedicate just one weekend to invest in yourself, I highly recommend joining this 2-day weekend AI training program which is completely free. Thanks to our partner for today, Outskill. It is the world's first AI-focused education platform which is backed by renowned AI investors and AI founders. This 2-day program offers 16 hours of live AI training spread across 2 days happening coming weekend on 1st and 2nd of March from 10 a.m. to 7 p.m. It is usually a paid training but you can attend it completely free from the link I provided in the description. In this program, you will gain in-depth knowledge on a wide range of topics including more than 20 AI tools to build AI toolkit, prompt engineering to achieve incredible results, data analysis without coding, using AI in Excel and creating professional presentation effortlessly, building tools with AI without writing code, creating stunning images and videos using AI tools, developing AI agents, automating your work to save time and boost productivity, and that's just the beginning. Professionals from tech and non-tech sectors like sales, marketing, HR, operations, and even business owners and freelancers had attended and loved it. In fact, I am getting my team to attend this workshop and I would definitely recommend you to attend this. Please note that there are limited slots and they are filling up faster. So check the link in the description and book your slot. Moving on, the next stock in the list is Medi Assist. It's a small cap health tech and insurtech company that acts as a facilitator between insurance firm, policyholder and healthcare provider. Company got listed in January 24 at around 420 rupees. It jumped more than 50%, but it has corrected to levels of around 480 now. Now public holding in Medi Assist has not reduced, but promoter holding has fallen. But then promoter selling is a negative indicator, isn't it? Not always. I've explained it earlier also, where if the promoter of the company is a PE firm, it can book profits. The important question is, who is buying the stake? In case of Medi Assist, its promoter firm Bessemer India has reduced stake that is completely absorbed by both FIIs and DIs that increased the stake from 9.6% to 14% and 30.6% to 42.7% respectively. It includes top foreign institutions as well as top domestic institutions. So strong hands have purchased stake in Medi Assist. In fact, the last major buying by institutions happened in September 24 at levels of 612. And today, stock is trading below 500 rupee with a PE of 35 and EV to EBITDA of 18. Considering the growth potential in healthcare sector of India and profitable business model of Medi Assist, the valuation looks quite tempting after the correction. I've already done a detailed video on this company. Third stock in the list is Nuvama Wealth. It is one of India's leading wealth management firm that caters to HNI and ultra HNI segment. If you look at the shareholding pattern, company launched its IPO in June 23, where public holding was around 32% and rest was with promoters and FIs. This public holding kept increasing till June 24 to 36.15%. However, in last 2 quarters, there is a sharp fall in public holding and both FIs and DIs have significantly increased stake in the company. FIs have more than doubled their stake in just 2 quarters and include reputed names like Small Cap World Fund, Government Pension Fund, Goldman Sachs. Now I remember doing a detailed video on Indian wealth management sector where I discussed a report that mentioned that affluent population in India is currently around 60 million and expected to touch 100 million mark in next few years. Obviously, when people earn money, they need professionals to manage it. And that's where Nuvama can be a strong beneficiary of this trend. But I also mentioned that there is one key risk with wealth management firms like Nuvama. The risk is wealth management firms' earning growth are linked to market performance. If the stock market does well, people invest more money. That's the case in recent couple of years and why all wealth management firms have outperformed. In fact, Nuvama has outperformed exceptionally with sales growing 5 times between March 20 to trailing 12 month and operating profit growing more than 4 times between March 21 to trailing 12 month. As a result, its share price also zoomed from around 2,400 levels to more than 7,000 levels. Please note that the business model of wealth management firm is such that they have a fixed expense, mainly include your employee salary. But as the business scales up with increase in overall asset under management, their operating profit goes up. That's called operating leverage. And that's what has happened with Nuvama as well, with margin growing from 32% to 52%. But if the stock market underperforms, investment flows can also reduce and that can impact the operating margins and earning growth. Since we have seen the market correction in the last few months, it would be interesting to see how much it impacts wealth management firm like Nuvama. I think if the slowdown persists in the Indian economy, Nuvama can see contraction in earning growth. That is one of the key reasons its stock price has fallen around 25% from the highs. I've already discussed it in one of my recent video on sharp correction in capital market stocks. After the correction, Nuvama is trading at a PE of around 22 and EV to EBITDA of 6 with market cap of around 20,000 crore versus competitors like 361 that are trading at a PE of 38 and EV to EBITDA of 21 with market cap of 40,000 crore. So valuation at the moment is quite reasonable for Nuvama. But if earning growth in the near future falls, PE can rise. It would be interesting to see how institutional investors react to upcoming quarterly earnings. Having said this, in my opinion, wealth management as a sector is still in nascent stage in India and has immense growth potential for the next few decades. And Nuvama should be a strong beneficiary of this structural trend over the next 5 to 10 years. So corrections would create opportunity. Especially investment done during the bear market phase would reward investors in the long run. Yes, it may take the test of patience and conviction if the stock market slowdown persists for a long period. But in the long run, Nuvama is a great SIP grade stock, worth studying in detail. Then fourth stock is Gokaldas Export. It's a leading apparel exporter from India to the US. Public holding in the company has consistently reduced in last 10 quarters from peak of 41.39% to 27%. Although its promoter holding is very low and has reduced in last many quarters. That's because Gokaldas had a long history of underperformance. However, in 2017, company had a huge reshuffling where experienced professionals got into company's board to run the organization. I've already explained this in one of the detailed video long back. After that, company had a great turnaround story where revenue kept on rising at a fast rate and operating profits went from negative to massive profits. And that resulted in consistent increase in FI stake from 11 to 26%. Plus it includes top quality FIs. Likewise, DIs increased the stake from 24% to now at 37%, and again, it includes top quality domestic institutional investors. Recently, Gokaldas share price is corrected around 30% from the peak and now trading at EV to EBITDA of 18 with market cap of around 6,200 crore. P is showing high levels of 41, but that is due to recent acquisitions as well as capacity ramp up. So going forward, as the capacity ramp up complete, margin should expand and P should come down. Having said this, near term can be very volatile because Gokaldas' key market is US and there's a lot of volatility in the US after Trump has taken over as president. So any negative news from the US economy in the near term can impact Gokaldas share price. But the long-term story for Gokaldas looks quite promising. Hence, this correction in 2025 should create good investment opportunity in the company. Fifth stock in the list is Newgen Software. This is one company I have discussed multiple times in the past. It has been a massive wealth creator in the last few years, but there's a sharp 45% correction. In fact, I recently discussed the reason for correction in Newgen. If you look at shareholding, public holding in the company is consistently falling from 23% in December 22 all the way to now at 16%. While DIs have not increased much stake, FIs have consistently increased stake from 13% to now at 20%. After the correction, Newgen is trading at a PE of 46. Now, considering the fact that company has been growing at north of 25% with excellent return ratio, negligible debt, high cash conversion, it would command a premium. But PE of 46 is slightly higher side. As mentioned in my last video, anything near a PE of 40 would be worth considering. Sixth stock in the list is Federal Bank. Public holding in Federal Bank has been consistently reducing from 31.6% to 24.7%. While FIs have slightly reduced the stake, DIs have consistently increased stake from 42% to 48.9%. Interestingly, Federal Bank share price has not corrected much in this market sell-off. The key reason is bank has been growing consistently with very good asset quality and valuations are quite reasonable at PE of 11 and price to book of 1.45. Recently, Federal Bank had got a very prominent banker, Mr. KVS Manian, as its new CEO and MD. He was in Kotak Bank for 25 years and played a very important role in its transformation from an NBFC to one of India's top private bank. He recently held an analyst meet where he shared the future roadmap for Federal Bank and called it Era 4.0. Federal Bank aspires to be among top 5 private banks of India. Seventh stock in the list is Ganesha Ecosphere. It's a leading plastic waste recycling company in India. I've already done a detailed video on this company. Public holding in the company has consistently reduced from 40% to now at 29.9%. While DIs did increase the stake earlier, there is not much change in last few quarters. Although FIs have consistently increased the stake from less than 1% to now at 12%. In the recent correction, company share price has fallen 40% and now trading at a PE of 35 with market cap of around 3,500 crore. Company's management has guided for 1,800 to 1,900 crore of revenue for FY26. In trailing 12 months, company did revenue of 1427 crore. So excellent growth expected in the near term. Plus, company is now focusing on increasing contribution from value-added products, that is rPET granules, from current levels of 40% to 60 to 65% in the next 2-3 years. And these value-added products have better margin of more than 20% as compared to company's current margin of 14%. So as the value-added contribution would increase, the margin should also increase. Although there is one headwind for the business today, where the fall in crude prices can negatively impact the profitability of company's legacy business, which is recycled polyester staple fiber. Having said this, recycling is a big theme for long term and there are multiple tailwinds for the company where the focus is on sustainability. Then 8th stock in the list is E.I.D. Parry. Public holding in E.I.D. Parry has consistently fallen from 44% in December 23 to now at 32.3%. FIs have consistently increased stake from 8.7% in December 23 to 12.6%. DIs have consistently increased stake from 4.5 to 13.29%. Now E.I.D. Parry is a holding company of Coromandel International. Both are part of prestigious Murugappa Group. E.I.D. Parry has 56.18% stake in Coromandel, and today Coromandel International command a market cap of 48,000 crore. At 56.18%, it is equivalent to a valuation of 27,000 crore for E.I.D. Parry just from Coromandel business. Although Coromandel PE is around 30% higher as compared to its median valuation. So if we subtract that valuation, E.I.D. Parry would have a fair market cap of around 19,000 crore only coming from Coromandel. Now holding companies usually trade at a discount of 40 to 50% as compared to their actual holding value. So that translates to a market cap of around 10,000 crore from Coromandel holding. Now E.I.D. Parry has its own standalone sugar business of around 3,000 crore. But you can't give high PE multiple to sugar business. So assuming a price to sale of just 1 to 1.5 times, E.I.D. Parry should get another 3,000 to 4,000 crore from its sugar business. Adding both standalone business and Coromandel, it translates to a fair market of around 13,000 to 14,000 crore for E.I.D. Parry. And currently, company is trading at a market cap of around 12,000 crore. So there's a decent 10 to 15% discount as compared to the fair valuation. And the most interesting part is E.I.D. Parry has an ambitious goal to transition from its traditional sugar business to more of an FMCG player. Company has also moved up the value chain with branding of its sugar business along with launch of many consumer staples. But please note that it's a long-term journey for the company. It won't happen immediately. Having said this, Murugappa Group is known for creating immense wealth for its investors. The ninth stock in the list is Praj Industries. Public holding in the company is reduced from 44.5% in March 22 to now at 30.3%. FI holding in the company is sort of constant in last few quarters, but DIs are consistently net buyers from 7.7% in December 22 to now at 18.2%. Praj Industries' last couple of quarterly results were weak and stock has fallen nearly 40% from the peak. But this is again a long-term play on biofuels with multiple growth drivers including sustainable aviation fuel, low carbon ethanol, compressed biogas. And there is a strong growth coming from export where management expect to increase export contribution from around 27% at current levels to 50% by 2030. This is mainly driven by ETCA, that is Energy Transition and Climate Action. In the long run, company's management has guided for 3 times growth in top line by 2030 as compared to 2024 levels and 5 times growth in net profit. So worth tracking the development closely. Currently, it commands a PE ratio of 39 with a market cap of around 10,000 crore. So in this video, we discuss fundamentally strong mid and small cap stocks that have corrected in the range of 30 to 50% where institutional investors are consistently increasing stake. Now I know that at this time when all mid and small cap stocks have fallen brutally and there's so much panic in the market, nobody would have the courage to buy these stocks. But remember that you never get good news and good price together. You only get good price when the news is bad. Again, I'm not saying that you directly jump and buy all these stocks. All I'm saying is there's an excellent correction in these companies and it's worth studying these stocks to identify a few promising investment opportunity where you can consider allocating some money in a systematic manner. Now tell me, which stock do you think is looking very promising after the correction? And before we close this video, there's an introductory call for 2 days AI session that would happen on this Friday at 7 PM IST. So don't miss this. Click the link in the description and book your slot. You can also join their WhatsApp group to receive all updates. Thanks for watching this video. I'll see you in the next video. Till then, take care.